Module 7, Special Journals. Principles of Accounting Information System. The 5 fundamental principles of accounting information systems are control, relevance, compatibility, flexibility, and cost-benefit. Output device. An output device is a hardware component that displays, presents, or communicates the results of data processing or computing to the user or other devices. It converts electronic signals generated by the computer into human-readable or machine-readable forms. Examples of output devices include monitors, printers, projectors, speakers, headphones, and data projectors. Each type of output device has its unique features and characteristics. For example, a monitor displays visual data as images, graphics, or text on a screen, while a printer produces hard copies of the data on paper. Similarly, speakers and headphones provide audio output, while a data projector projects images or video onto a larger screen or wall. Output devices play an essential role in making computer technology accessible and useful for everyday tasks, enabling users to receive feedback and information from the computer in an understandable and meaningful way. Special journals. Special journals are accounting books that record specific types of transactions, such as sales, purchases, cash receipts, and cash disbursements. They have several features that make them useful for recording and organizing accounting data. Predefined formats. Special journals have predefined formats tailored to the recorded transaction type. For example, a sales journal will have columns recording the date, customer name, sales amount, and other details specific to sales transactions. This allows for consistent and accurate record keeping. Time saving. Special journals save time because they allow for quick and easy entry of transactions. The predefined format means that information can be entered into the journal quickly and accurately without spending time creating a new format each time a transaction is recorded. Improved accuracy. Using special journals improves the accuracy of accounting records because it reduces the likelihood of errors. Since each transaction is recorded in a specific journal, there is less chance of recording it in the wrong place or omitting important details. Easy to analyze. Special journals make it easier to analyze accounting data because transactions are grouped by type. This allows for easier identifying trends and patterns and easier preparation of financial statements and reports. Facilitates audit trail. Special journals provide an audit trail for transactions, which makes it easier to trace the flow of transactions through the accounting system. This is important for internal and external auditors who need to verify the accuracy of accounting records. Special journals can improve accounting records' efficiency, accuracy, and reliability. They are essential for any organization that wants to maintain accurate and organized accounting records. Merchandise return. Merchandise return refers to returning goods or products purchased by a customer to the seller or retailer. This could be due to various reasons, such as the product needing to be fixed, not meeting the customer's expectations, or not being needed anymore. In many cases, a customer may request to return merchandise to the seller or retailer either in-store or online, and the seller will typically have a return policy outlining the conditions under which merchandise can be returned. These conditions could include time limits, conditions of the returned product, and the mode of refund, either cash or store credit. When a customer returns the merchandise, the seller usually verifies the product's condition to ensure it meets the return policy conditions. If the return is accepted, the customer will receive a refund or store credit, depending on the policy. Merchandise returns can be an essential aspect of customer service as it gives customers a sense of security and trust when making purchases. It also helps build customer loyalty and can be an opportunity for the seller to address any concerns or issues the customer may have had with the product. However, merchandise returns can also be a source of cost and inconvenience for the seller, as they may have to bear the cost of shipping, restocking, and handling the returned product. Many sellers have strict return policies to ensure that only legitimate returns are accepted. When an original purchase by a customer is made on credit, the selling company should record the payment for merchandise, minus any return, in the accounts payable ledger. When the merchandise was purchased on credit, the company would have recorded a credit to accounts payable and a debit to purchases. When the merchandise was returned, it would record a credit to purchases and a debit to accounts payable for the amount of the return. Purchases Journal. A purchases journal is a specialized accounting book that records a business's credit purchases of merchandise or goods. It is also known as a purchase book or a bought day book. The purpose of a purchases journal is to provide a centralized location for recording and summarizing all purchases made by a business during a given period. The purchases journal typically contains columns for the date of the purchase, the name of the supplier, a description of the goods purchased, the amount of the purchase, and any applicable taxes or discounts. The entries in the purchases journal are typically made in chronological order, with each purchase being recorded on a separate line. The purchases journal records purchases made on credit, meaning that payment is not made at the time of the purchase. Instead, the supplier will send an invoice to the business, which is recorded in the purchases journal. Once payment is made, the entry in the purchases journal is updated to reflect the payment. A purchases journal helps businesses keep accurate and organized records of their purchases, which can be used for various purposes, such as calculating the cost of goods sold, preparing financial statements, and monitoring inventory levels. It also helps to ensure that all purchases are correctly recorded and that no purchases are overlooked. In addition to the purchases journal, businesses may also use other specialized journals, such as a sales journal, a cash receipts journal, and a cash disbursements journal, to record other types of transactions. Assume that a company using a purchases journal made an error in totaling the journal's accounts payable column. The error should be discovered when the total of the schedule of accounts payable is compared with the balance of the accounts payable account. Cash receipts journal. A cash receipts journal is a specialized accounting book that records all cash a business receives. It is a chronological record of a business's cash inflows during a particular accounting period. The entries in a cash receipts journal typically include the date of the transaction, the name of the customer or payer, the source of the payment, such as cash, check, or credit card, the amount of the payment, and the account that is credited with the receipt. The Cash Receipts Journal is an essential tool for businesses to keep track of their cash inflows and to ensure that all payments received are properly recorded. By recording all cash receipts in the journal, businesses can easily reconcile their cash accounts and track their cash balances. The Cash Receipts Journal is handy for businesses that receive large cash transactions, such as retail stores, restaurants, and service providers. It can also record other receipts, such as interest, dividends, and rental income. In addition to the Cash Receipts Journal, businesses may also use other specialized journals, such as a Purchases Journal, a Sales Journal, and a Cash Disbursements Journal, to record other types of transactions. Specialized journals can help businesses keep accurate and organized records, which can be used for various purposes, such as preparing financial statements and monitoring cash flow.